Welcome back, ladies and gentlemen. In this video, I'll talk about institutional sponsorship. Institutional sponsorship and how to find trades that are sponsored by institutions. Now, when you're trying to take on a long position, of course, you know that at any moment in the time, at any point in time in the market, you can afford to buy or sell the market, right? So, like, I can afford to buy, the market right now at $62. But that doesn't necessarily mean I'm going to make money on that trade. Now, you already know that the people behind the price action are the big financial groups. So, if you want to make money in the market, if you want to put on the type of trade where you get an entry from, say, an area like, you want to put a type of trade where you get an entry from the low like this, and the price shoots up all the way from your entry point. Those type of trades, when the price moves lethargically in that direction, that's what we refer to as an institutional sponsored trade. Because evidentially from the price action and the candles you observe on the charts, you can tell that a lot of money was injected into the markets. Okay? So now I'm going to give you the frame for creating a playbook, right? So the goal of this video is for you to find out how to determine areas where the institutions are going to come in, so that you can take institutionally sponsored trades. Okay? So if we drop to the weekly time frame on this chart, you see that the market has been making a bunch of swings, expansions, contractions, expansions, contractions, expansions, contractions, expansions, contractions, henceforth. Now, you can tell that the market has been protecting the lows, okay? So do you see how the market has been forming lows, higher lows? And look at the highs. It has been forming higher highs. So this high formed and it got taken out when price came and reached this high. This high formed and it got taken out when price came and reached this high. Formed, then this high got taken out here. It's taken out here. Got taken out here. Okay? So you can tell that the market is in a bullish order flow. So when order flow is bullish, because institutionally sponsored trades are directionally based on order flow. Meaning if you want to take an institutionally based trade, an institutionally sponsored trade, that trade should be in line with order flow. It doesn't matter if the order flow is if it's monthly order flow or weekly order flow or daily order flow or interim order flow, which is the 15-minute. All that matters is if you're going to be short on the 15-minute and you're looking for institutionally sponsored trades, then you want to be shorting a market that is in bearish order flow. And likewise, the same goes for a bullish order flow scenario. Okay, so in this market, we know that we're in a bullish order flow scenario. And what do you know about bullish order flow markets? You know that price moves in swings. So this was the first swing from this low of this candle, right? The low of this candle is 2.72, and this swing goes and makes this high here at 7.17. That's the first swing in the market. Now you understand that when the market makes a swing, it creates a range, right? So the market creates a range, and in that range, you have what? You have two sides. Remember? You have the discounts portion of that range, and you have the discount portion of the range at the bottom, and you have the premium portion of the range at the top. So discounts is cheaper prices, premium is more expensive prices. You remember I told you buyers buy discounts and sellers sell premiums? That is the principle. So you have a market as in bullish order flow, and you want to take an institutionally sponsored trade. The first thing you want to do is you want to identify the discount portion of the market, because an institutionally sponsored trade will not start in the premium, it will start in the discount. Why? Because the buyers are going to wait for price to return to the discount for them to buy again. Okay? So in this scenario, this is the premium portion, and the lower part is the discount portion. So in this scenario, we can take off this swing and this line. And what we're going to do is we're going to use our Fib tool to draw the low to the high of that swing. Low which is 2.76 to the high which is 7.23. And price goes to the discount of that range. Do you see that price just dips into the 0.5% level? And what does price action do when it happens? When that happens? Do you see how price shoots from returning to the discount area? Price shoots upwards and away. Up and away. So the first thing you want to identify in the market when you're looking for an institutionally sponsored trade is, what is order flow? Okay, now if order flow is bullish, where is the discount? Because buyers are going to buy discounts. If order flow is bearish, where is the premium? Because sellers are going to sell premiums. So now you know what the range is. The range is this move from this low to this high. Now the next thing you're going to look for is, where are the liquidity pools? So I remember I told you in the liquidity pool lesson that when a swing is created, there's internal and external liquidity. The external liquidity is in form of sell stops resting below this low. You know, when the buyers bought this low, they have their sell stops resting there, and buy stops resting above this high, because sellers sold this high and the sellers put protective buy stops above the high. So those are the liquidity pools externally. Now inside of this range that was created when price made this impulsive swing upwards, inside of that range there are also liquidity pools. So let's identify the liquidity pools inside of that range. All right. So first of all, we have this down close candle into a resistance, so a support area, forming a long wick. Price trade into that long wick. Price finds support at that level, and then we see an up close candle. This up close candle So, cut from here, John. Let's start. So now we observe this down close candle, which obviously had this long wick, and price found support after touching this low of 273. Right. Now, sellers try to sell this candle into the low. They can't. Buyers gain control, and this candle ends up as an up close. Now the second white candle we observe is a much larger big body up close candle, and it trades higher than this down close. Okay? So we will mark that out as an order block. All right. Now, price trades above this order block to confirm it. And then when it trades down into this is a weekly up So we'll call this a weekly bullish order block. And price trades back into this bullish order block, and trades back into the 50% threshold. Do you see how the 50% mean of this down close candle, which is at 3.69? If we take this candle to 3.69, this line to 3.69, you see that that's exactly where this candle opened at, this up close candle. That's where the volume of this institutions on this up close candle starts. All right. So this is a pool of liquidity and price taps into it. On tapping into it, price goes and rallies higher, and that creates a mitigation block. All right. So price trades into this down close candle and rallies higher, creating a mitigation block. Do you see how we have a low here, rally up, then a lower, then a higher low, and then a rally higher? So that's a mitigation block. All right. So this is another pool of liquidity created internally on this range. All right. And you know that the sellers who sold this position, when price rallies against them, if price can return back to their entry point, they will close their short positions for break even, injecting even more buy orders into the market. And you see what happens when price touches that level? Look at this up close candle. The high of this down close candle is 4.38. The low of this up close candle is 4.38. So this up close candle low, the lowest price literally reached was the highest this down close candle reached. So when those short sellers got the chance to close their positions and net break even, they did. And look at the next candle that follows, the lethargic upside movement, and the trade goes on. Now look at this look at it even within this upside movement. What do you notice here? In this imbalance, this big candle creates an imbalance in the market. This imbalance creates this up close candle creates an imbalance in the market, leaving us a fair value gap. So you can go ahead and mark this. So we'll take, you know how a fair value gap is formed? It's the gap created where it's only buy orders injected into the market. And you can identify it by look at the high of the previous candle and look at the low of the next candle, and you see there's a gap formed. This fair value gap. This box represents that area on the chart. So you see when price returns to this fair value gap in the future, you see that buyers actually buy that fair value gap. And when you observe the chart even further, you have a liquidity void going up the rest of the way. All right. So now you know that there's a fair value gap here, called the MF. That FVG stands for fair value gap. We also have a mitigation block here, and we have a bullish order block here, right? So remember, order flow was bullish. We had a range in the market with a premium section and a discount section, and in the discount section we have liquidity pools in the form of order blocks, another mitigation block, and a fair value gap. These are bullish liquidity pools. So when the market is in a bullish order flow, if you're looking for an institutionally sponsored trade, you map out the range of that swing. When price dips into the discount, price will want to reach for a liquidity pool in the discount. So you need to also know where the liquidity pools are. And when price gets into the liquidity pool, then you execute your trade. And what you're looking for is you want price to return and fill the buy stops that are resting above this high. So this is your trade. Your trade is going to be from this mitigation block. When price comes into this mitigation block, then you're looking for an entry and you want to take a trade from this mitigation block, targeting the sell side liquidity in the market. Where are the sellers going to come into the market? Because since I'm buying, I need to sell to somebody. I need to sell to People who sold in the market, people who sold, they put their what? They put their buy stops above. So those buy stops I can pair with my sell orders. So those sell orders are going to be sitting where? They're going to sit above the highs. So those buy stops will be sitting above this high. There will be buy stops above this high. There will be buy stops above this high. There will be buy stops above this high. Every swing high has buy stops above it. So when the market starts to rally, the market is going to reach for this buy stops, then these, which it does here, then this. Let's zoom out of the chart and see if it does. Oop, and it does. You see right here? And then this right here. Okay? This right here, this whole area. There are going to be orders inside of it, sitting above it. So now replicate this formula on the next swing. Bullish order flow, the same thing. Bullish order flow, price creates an impulse swing. Right? You can see price creates this swing. This swing leaves us with a range. So you can take the low of that range, which is the low of this candle at 4.01, to the high, which is at 12.34. So you see the premium portion of the range, you see the discount portion of the range. Okay. Now, inside of this range, you remember I told you there are going to be liquidity pools. The first liquidity pool you can see here is a bullish order block, where you see have this down close candle. See this down close candle? And then preceded by an up close candle that trades above the high. It also creates a fair value gap. So we have a fair value gap, which is, observe the high of this down close candle and the low of the low of the next candle between this big body candle. Creates a gap in the market. Okay. So we have a fair value gap, we have a bullish order block. Now price rallies higher. Price created another fair value gap here, as you can see with the high of this candle and the low of the next candle, but price filled it. When price filled that fair value gap, price ran even higher. It created another fair value gap here above this order block. And watch how price creates another bullish order block here with the fair value gap above it. Very similar to the combination we saw below. All right, and you see when that happens, let's zoom into that real quick. And notice how this fair value gap forms, which is this high here, and the low of this candle, which you can see right here. And notice how when this gap forms, the candle that trades into it, the next candle right here, this upwards candle, just trades into that low, taps into that bullish liquidity, and then see how it shoots up. Then it forms another fair value gap here. And the same thing too. Price trades into that pool of liquidity. After forming this gap here, big displacement, previous candle had a high, the next candle had a low, there was a gap in between. Price trades higher. When it comes back and taps into this liquidity, see this down close candle just trades into the fair value gap. Next we have an up close, and this up close, the low is of 8.25, and this leads to a rally. Sends the market. Sends the market. I almost missed my swing there. Sends the market higher. All right. can see a fair value gap appear here again. Price trades into it, but this time the market is bearish and sells lower. So these strategies don't work all the time because although they are patterns on the chart, it takes people behind them to back it up. If you want to learn more about the psychology behind how price action occurs, you should join my community and definitely check out the section on the ideal mindset for trading.